So I told you that our lesson today is going to be on internal range liquidity.
Yes.
Internal range liquidity, and I already told you that since we have two, I mentioned that the market moves from internal range liquidity to external range liquidity. All right, and external range liquidity is simply swing highs, swing lows, and all that. So, which means that, I mean, if the market is going for external range liquidity, normally it should be going for old highs and old lows. That's just it about internal range liquidity. I mean, external range liquidity. And also, you will notice that sometimes an external range liquidity, which is a high like this, is still going to be like maybe an internal range liquidity found on the more higher time frame. Now, I'm going to break that down. I'm going to break that down when you look at it. Okay. Now, when you look at when we are looking at internal range liquidity, which is based on order blocks, let me actually put that down. We have internal range liquidity. We are going to have order blocks. Okay, we are going to have fair value gaps. We are going to have volume gaps. We are going to have volume gaps, and we are going to have breakout blocks. So we might actually talk about all of this today because I think it's not going to be too much of a I mean, like, it's not really going to be, I mean, it's going to be like advanced explanations. So we have internal range liquidity, and under internal range liquidity, we have order blocks, we have fair value gaps, we have volume gaps, we have breaker blocks, and under external range liquidity, what we have is simply just old highs, old highs and lows. We also have equal highs. Okay, we have equal highs and lows. So that's just basically what is found on when it comes to external range liquidity. But like I mentioned to you, and I'm just going to quickly show you an example now. When we are talking about old highs and old lows, okay, old highs and old lows. Yes. Now, for example, if you look at price here, all right, let's look at this. Let's go to the weekly time frame. I think I should just remove all the trends here. Okay. Now, look at this thing. Remember that I mentioned under internal range liquidity, we have fair value gap. So, which means that this is actually what? An internal range liquidity, right?
Yes.
Internal range liquidity, which is equal to FVG.
FVG.
Am I correct?
Yes.
Okay. So we have internal range liquidity in this case, which is a fair value gap. But now let's study the high of this fair value gap. I want you to pay attention to this high. Okay, pay attention to the high of this fair value gap. I'm going to put a line there, and then we're going to move to the lower time frame. Let's make it a little bit thicker, and then we go to at least 1 hour time frame now. Okay, now look at this is the same high here. This one. This is the same high. This is the same. This is the high of the fair value gap on the weekly. But now, when you're looking at it on the lower time frame, it is external range liquidity, right? Yes. Because it's now an old swing low. It's an old swing low on the 1 hour, but on the higher time frame, it is just internal range liquidity. It's just a fair value gap on the weekly. You don't really see it to be like a swing low. But then when you drop down to the lower time frame, and now you're trading, if you're looking for shorts at this period, if you're looking for shorts, like we did a few days, which we had some sales coming in from that zone, we were targeting external range liquidity based on the 1 hour, and then targeting internal range liquidity based on the weekly time frame. Now, this might sound very complicating, but as we move forward to actually explaining what internal range liquidity is and all that, I think it will be very easy for you to graph it. All right. So for now, where are my lecture? I think it was that on the 1 hour time frame. Okay, I actually deleted my drawing style. I get it now. Anyway, so we are actually on internal range liquidity, and we are going to start first with order blocks. Okay, we're going to start first with order blocks. Now, On these other blogs, I've come to notice that a lot of people, everybody has his own personal definition about it, right? About other blogs. You never, I mean, somebody can define another block to be a demand zone or a supply zone, and it works and it's
Yes.
working for the person. Another person might define it to be like a support level or a resistance level, and it's still working. Another person will say that okay, it is an institutional zone where institution place their orders up and down, all those things, and it still works, right? So all these concepts they actually work. But what I'm trying to say is there is no one way of defining it. I will not tell you that the definition I'm giving you is the best one, but based on the definition I'll give you, we as we are moving forward, we're also going to see that we're going to also have. I mean, we're going to prove that it works, right? We're going to prove that it actually works. And when you're defining something, especially when it comes to trading, the most important part of it is to actually the most important part of it is for you to understand the logic behind what you're defining. Okay, understand the logic
Yes.
because it's not just about patterns. When you understand the logic behind the definition that you're giving, that's when it changes everything. I don't know, are you getting me clearly
Yes, I can get you clearly. Yes, I can get you very clearly.
right now, right?
Yes.
It's okay. All right. Now
Yes,
let's
it's clear.
let's define what an order block is. Okay. Now, first, let me just give you the logic behind order blocks. Now, order blocks are simply candles where we believe that institutions have placed in their orders in. All right. Like for example, we know that we are maybe using the smart money concepts or there is trading like the institution. So what we need to do as normal as retail traders, the only advantage we can have in this market is to find a way to be able to trade alongside with these institutions because normally they are the big whales and they are able to move price based on the amount of capital that they actually have, right? It's just like when you go to the market, prices of things in the supermarket are always expensive, and this has been sponsored by rich people, right?
Yes.
This has been, let's just
Yes.
say, for example, that you, President Trump, is going to a
Yes.
supermarket to buy a bottle of water for maybe let's say 50 cents. I don't think that will really make sense, right? Based on the type
Yes.
of person he is. So now you're going to notice that there are going to be some supermarkets where he's going to maybe you buy a bottle of water for $10. Maybe you understand what I mean. So um, uh, prices of things fluctuate based on the capital coming in or based on who is interested in buying that particular thing. It's also, you can also notice it when it comes to auction prices and stuff. When they're auctioning something, the person that has the highest money will always win, and due to that, the prices will always rise to a certain level where the masses cannot afford again before he gets it. Now, what that simply means is for us to be able to make money in the market, the advantage we have is that we can
Yes.
be able to follow the footsteps or the footprints of the institutions. If they are buying, we buy. All right. If they are selling, we sell
Yes.
because we cannot literally trade against them because, I mean, we don't have that capital. And if they are intentionally buying, price will likely have to move to their direction because of the amount of capital they have. So how do we now follow this institution? That's where other blocks, fair value gaps, and all these internal range liquidity PDRs come in. Now, talking about
Yes.
other blocks now we are looking at a candle where institutions will now place their orders in, right? We're looking for a candle where
Yes.
institutions will place their orders in. Now, let me quickly show you an example of actually what I'm saying now. When you look at this market, what do you see on this market that looks strange? If you look here, you'll notice that there is one candle here that is so big.
Uh, yes. Yes.
It's really big.
The
Yeah, it's
yeah.
really big. So when you notice
So
something like this in the market, what should come to your mind is like, this move is sponsored because we are not having this type of candles, we are not having this type of movement. But then what happens to this sudden formation of this particular candle? It shows that something is behind it. All right.
yes,
It's not just an
yeah,
ordinary move. Yeah, it's not just an ordinary
yes,
move. So we believe that, okay, this is a sponsored move by the institutions. And this literally shows to us that institutions are interested in selling. All right.
yeah,
It shows us
yes.
that
That's
institutions
true.
are
Yes,
interested in
that's
selling. Now,
right.
so what do? We as traders now, we want to find out where they got in so that we can be able to move in their direction. But now, if because I'm going to now let me explain another method. Okay, now since the
Yeah, yeah.
institutions have a lot of capital, all right, let's say they
Mhm.
want to enter a trade that is worth $1 billion. Now they're not going to enter $1 billion at once. If they do that, price is going to skip so badly. They're going to have a heavy volume gap that might be too big, right? So what they do is they cut their position into two. They enter 50%, all right? They enter 50%
Yes,
and you cause a move like this one, okay? And now
yes,
when the price
yes.
comes back, they enter the remaining 50%.
50%.
Good. Now, another explanation is this. This is another explanation. When they want to enter this position, what they're going to do is they're going to buy and sell at the same time.
Mm-hmm.
Now, it's a little tricky, but you have to understand something. If they are the only ones selling, where would buyers come from?
The retail, maybe the retailers.
Well, if they just wanted to push price down like this, I mean, they will not have that
Yeah,
enough buyers at the moment. So
yeah,
what they do is
yes.
they're going to buy and then sell, right? Now, when
Oh, yeah.
prices drops, they are buying to provide liquidity for the selling positions. So when prices drops, what happens? The buy orders are in a negative. Okay, the buy orders are in a
Yes.
negative, and where would you have buy orders? You're going to have buy orders on this bullish candle. Okay, you're going to have buy orders on this bullish candle and then sell orders on the bearish candle. So this means that their buy positions that are on this bullish candle are in a loss. So what happens is that they are going to bring price back to that order,
Back, back.
candle,
Yeah.
right? They're going to
You said
bring
it. Yes.
back to that candle to do what we call mitigation.
Mm-hmm.
You know what mitigation means?
Not really. Like,
Mitigation means mitigation is
you
like
said.
cutting something, cutting losses or cutting something.
Oh,
Like,
okay.
yes. So when price comes back, they are mitigating their losses on this bullish candle, which means as the market is going back, they're closing their buy position. And they will do what?
Yes.
They will add the remaining sell orders, and that's why you see the market dropping. So
Mm-hmm.
we notice this movement that this is what the institutions are doing, and this is where we wait for them. When they are coming back to mitigate their orders, we enter because what? Now remember, it will be difficult for you to know that they were buying here and they wanted to sell on this one. It will be difficult. It will be very difficult.
Yes.
Yeah, it
Yes.
will be difficult because you don't know if they're buying here and they'll keep buying. But now when you notice that they bought here and then they sold this way, breaking structure to the downside, that simply means that
So
we have seen that,
the
okay,
market has shifted. Yeah.
yes. So we now understand that, okay, their intentions is actually to push price down. So then we wait for the mitigation. We wait for the mitigation leg. And when it comes for mitigation, this is where we leverage. This is where we join them. You understand now? That's
Yes.
that's that's like the
Uh,
logic. That's the logic behind this explanation. That's the logic behind other blocks. Now we will then start to say, okay, uh, what makes another block strong? Because you're going to have so many, you're going to see other blocks that are failing, other blocks that are not strong, and all that. Now you're looking at, okay, what makes another block strong? What makes another block valid to use? Because it's not every other block that you see that price will respect. Now, because some other blocks are going to turn to breaker blocks. Okay, some other blocks
Oh,
will
okay.
turn to breaker blocks. All right,
Yes.
some other blocks will turn to breaker blocks and so on. That's why not every other block will work. And this is going to be based on institutional order flow, which is actually something we talked about. Institutional order flow, which is based on the higher time frame. Like where is price going on the higher time frame? It's just like, for example,
Yes.
it's just like, let's say, for example, here, if the market was supposed to maybe go up to a key level here, like let's say
Mm-hmm.
there was a key level here and the market created this other
Yes.
block. What might likely happen here is that the market will
The
come back,
price will drop,
break the other block, retest it now,
and
breaker,
then go up.
yes,
Yeah.
and go up. So it will not mean like this is now this when price comes, they're still going to mitigate others, and then as the market goes back
Mm-hmm.
comes, they're going to add more positions. Now, I believe you've actually understood the logic behind all this. Now, let's define it
Yes.
based on candle formations. Let's forget about institutions for the moment and actually define it. Now, the definition I'll give you, I hope you're going to write, is going to be based on some couple of things, okay? The first
Okay.
thing is we are talking about, now this definition is like giving you elements that will make another block valid, okay? Now, when we are talking about bullish order blocks, okay, when we're talking about bullish order blocks, the first thing that a bullish order block we expect it to do is to take out liquidity. Okay,
Okay.
take out
Yeah.
liquidity. Taking out liquidity simply means it should clear a high like this and then move
Mhm.
down, breaking a structure. All
Yes.
right. When that happens, when price clears liquidity and then comes down to break structure, now this is not a random move. It actually means that institutions sponsored price above this high. Okay. And when the market sells down, they will then spot that last bullish candle, which they place their buy orders in before selling, because those buy orders now in that candle are going to be in a loss. So we expect price to
Yes.
come back so that they can close those losses, and that's where we join the move. So the first element of a good order block is that it actually rates liquidity, just like we have here. Price took liquidity here, and then we are looking for the last bullish one, not this one. Okay? We look for the last bullish candle. Now, the next thing is a break of structure. All right, we'll also be looking to see if price break structure, because for some time when price takes a high like this, okay, let's say price breaks this high. Now at this point you cannot really say if it is going to be a turtle soap or if it is going to be a normal break of structure for price to continue higher, because the market could do something like this, respect the other block and continue higher. Okay, so it is when price stop hunts like that and then breaks below before we confirm that, okay, the last bullish candle here was actually an intentional move. Then we mark it out. Okay, that's the break of structure. So a break of structure validates a strong, a good order block needs a break of structure to validate its strength. All right. Now
It's
the next one,
Mhm.
the next one is it fills liquidity. Okay,
Okay.
it fills liquidity. What this means is that price, let's say, for example, we have a fair value gap like this, right? And then
Yes.
the market is pushing higher, and then we stop hunt a high. Take note, we stop
Mm-hmm.
hunt a high. So we have already filled this, okay? We stop hunt a high into that fair value gap. And then price moves down, breaking structure. So we have had a break of structure, we have had a stop hunt, and it has filled liquidity. Filling liquidity here means it's mitigating this FVG, or it's filling the fair value gap we have here.
Yeah.
All right, so our last bullish candle here will be a valid one for us to enter our trade from. Okay.
Okay.
Now,
Yes.
when it comes to higher time frames, okay, when it comes to higher time frames,
Yes.
we now bring it a little bit down. Okay, you will not see that, okay, when price
Mhm.
when it stop hunts or fills liquidity and price closes below that other block.
Mhm.
When price
Because
closes
the
below the last bullish candle, it validates that candle to be another block. That's now the other block entry you use when you are trading CRT.
yeah, that's it. Like the model one, the model one.
Yes, good.
Leave it.
We call it the model one entry, right? And that's
Okay.
actually the model one entry I used to trade here on uh, on GBP GPY today. Okay, today.
Okay. Okay.
If you notice, you will see that price took out this high. Now, this alone here was actually a CRT, but I know that I'm targeting right down here. This is my target right down here. Now, you go to 1 hour time frame. Do we have a key level? Yes, we had a very nice order block here. We had a very nice mitigation block here. Okay, we had a very nice
Yes.
mitigation block here. Now, when you're trading CRT, when you point out your 4-hour CRT, you use the 15 minutes for your entry. Okay, use the 15 minutes for
Yeah.
your entry. So when price came into the order block, the last bullish candle here, okay, we were expecting price to close below the last bullish candle, which is going to be a model one. All right, that was supposed to be your entry. Now this is already advanced. I didn't want to talk about this type of order block, especially on lower time frames, until we start
Okay.
talking about CRT. Okay, until we
Okay.
start talking about CRT. But for now, I just want you to understand the whole idea of identifying another block using the elements that I've mentioned. First,
Yes.
a tortoise must be created, a break of structure, and then it should fill liquidity. Okay.
A strong order block has to do the three of them, so to validate that now this is a proper order block that can make you to enter the market.
Yes.
Okay.
That is it. Now, it should have these elements, right? It should have
Yes.
these elements. This is very important. Now, this means that if price now, these two are actually
Yeah.
interchangeable. Sometimes the market will not start to soup. The market will not stop hunt. It will either fill a liquidity zone. Let's try to find out an example. Let's try to see if we're going to have an example somewhere. Now, there are situations that the market is going to maybe just fill a gap or even retest another block. All right. The market can actually retest another block and then form another one. Okay. Let me see if I'm going to have, let's see if we're going to quickly have such an example where in a situation where the market fills a gap and anyway, we have a breaker here. Good. Let's look at this one. This is a breaker block here. You can see that there was actually a sponsored push here to the downside, right? And before that push to the downside, price had actually stopped haunted this high, push to the downside, breaking structure. So this was a valid order block, but price broke it, so it becomes a breaker. After the breaker, the market came back to retest the breaker and then went higher. Now, there are also elements that we're going to use to actually validate a breaker, okay? Which is there should be liquidity, there should be a swing low like an inducement. We have not talked about inducement yet, but there's going to be an inducement leading to that breaker. Also, there is also going to be, you're also going to have good other blocks which also have inducements. Okay, but now I do not want to talk about that at the moment. I wanted to talk about that likely at the end of the lesson. Now, this is a breaker block that price has mitigated, and then it has went back up to like breaking a structure. And then we noticed that there was a candle here that came to retest this breaker. The last bearish candle was this one. So this also becomes our other block. And now again, price went up, break structure, came back again to mitigate the other block again. In this case, after the mitigation, we went back up again to break another structure. So here again, we have another other block. Now, these other blocks are not actually doing any stop hunt. They are actually just mitigating a previous key level. That's what I was trying to say, that sometimes you're not going to have a stop hunt. You're going to have price mitigating a zone. Like for example, this is an order block here, and then the market went below, breaking structure, and then formed another order block. So this order block is not likely like it. It was more about stop hunting, though it actually took liquidity above this high, but it was a mitigation to this order block. After that mitigation, price formed another order block. So this order block like this mitigated another order block. This actually increases the strength and the validation of the order block. All right. Now, there are two ways that you use order blocks also. You use order blocks on higher time frames as key levels. Okay. Which means if you have an order block on the high time frame, like for example, this one, if suppose that this was a daily time frame, when price comes back to this zone, we are going now to drop down to the 1 hour time frame and then look for a shift in market structure to the downside and then identify a new order block, which is going to be much smaller in a pip range. Because for example, if this was a daily, this would likely be like about 150 pips, right? But now, if price comes into this order block and we drop to the lower time frame here, and we are looking for a bearish order block, we might not see an order block that will just be about 20 pips. That's the reason why you are refining it to the lower time frame. We are looking for confirmation, so that because if you just sell here, you are going to have a stop loss above the order block, which is about 150 pips. But when you wait for confirmation to get in on the lower time frame, you will sell and you have a stop loss of about just 20 pips. That's the difference. But if you're a swing trader, you are going to be more exposed to bigger stop losses. Okay, so now we used another block on the higher time frame as a key level, and then we use other blocks on the lower time frame as entries. Okay, we use other blocks on lower time frames as entries. That's for example, this one here. I'm pointing this one because this is the most recent trade. I've enjoyed. I really enjoyed it since this January. This one. Okay. This is a lower. This is a 15-minute order block. Very clean order block. Price did all the stop hunt. We gave all the necessary elements, and also we had. Now let me talk about this before.
Yes.
Let me talk about this inducement. Now, inducement is just simply a market trap or a market tactics where it lures traders into taking the wrong side of the market. Okay. Now, for example, let's say, the market creates a low like this, went up, and now we have an order block here. Okay. Now we have an order block here, and you're going to notice that there's still going to be another order block here. Now, what is happening here is that the market has intentionally created this low, which is going to make traders want to continue to buy from here. And what is going to happen? Now, I told you on the time of market structure lesson that if the market needs to buy, it needs to trade to a zone where sell orders are, so that we are going to have sellers in a buying market. You will notice that sell orders are where we have sell stops that are sitting here. So if the market just buys from this point, we will likely not have sellers because sellers are instead sitting down here. Sell stops are here. So what should happen is that the market is using this swing low. It's going to use this swing low as an inducement into this order block. So the market is going to tap in the sell, and then institutions will mitigate their buy orders here, and then the market will move higher. So this swing low was like a trap based on false market structure. Okay, it's an inducement. An inducement is simply just where stops are sitting, where the market would want to trap traders in. Okay, because now at this point, as the market is breaking this low, people are thinking, okay, maybe now we are bearish. But the market needed sellers in a buying market. Institutions needed to buy from people that are selling, and the only way sellers could come in was if price trades below the swing low like this. Okay, when that happens, then price now can confidently buy. Now, sometimes you are not going to have that clear inducement like this.
Yes.
Sometimes you will not have your clear inducement like this. What is going to happen is that the market will actually build that key level, okay? And then it comes back and then it plays around here to generate that liquidity. Maybe it does something like this and people will start putting buy stops here. Remember, the market will always want to bring in traders to take the opposite side of the market. He has to create a zone where traders will have to put buy stops or sell stops in. Why are they putting buy stops here? Because if the market should break and goes up, they're going to be in profit.
Yes.
That's the plan. But now the institutions know, the market knows that this is not what we want. We want to sell, but we need people to be buying. So it needs traders to place buy stops here. If they are not willing to place it, the market will continue consolidating until they'll make up their mind to place the buy stops. And then what happens? Triggers into the order block. And then now this buy stop zone is going to be what? Inducement. We call it build of liquidity. We're going to really talk more about this.
Yes.
It's actually a topic on its own. Okay. It's actually a topic on its own because if you're not fully aware of it, most of the time you are going to be trapped. You're going to be trapped, right? Now, I was explaining that because here you will not have noticed that the market did something like this before coming. The market generated liquidity along the way. Just when he created this high, a lot of people felt like, okay, we are going down. If we're not going down, then we want to go up. So they are placing buy stops above this high. Forgetting to know that this is actually the market trying to engineer buyers to come in. And as people are seeing this break, the break above that high, they start to consider it to be a break of structure to the upside. And therefore, they're expecting price to continue higher.
Yes.
But then this was the original intention. Now, why are we selling in the first place? We know that the market went and grabbed external range liquidity, and we are selling because it is going back for internal range liquidity. It's that simple. I told you it's just a cycle. It goes from internal to external. And vice versa. So we went up, grabbed external, and then we are now going back for internal. And the market has even given us signs that this is where we're going. We've had reasons to create the sell to grab the internal range liquidity, which is the weekly fair value gap. So we are not just jumping into the market blindly. We know that, okay, the market needs to go grab internal range liquidity, but then we want the market to show us that this is actually what it wants to do. That's why patience is very important. That's why patience is very, very important. Patience is very, very important. So when you know that this is where the market has to go, especially because you need to know that coming from the higher time frame, when you're able to determine that on a higher time frame, what next that you need to do is you drop to the lower time frame to get confirmation that, okay, yeah, the market really wants to move to that direction. And the confirmations that you need is going to likely be another block and then some inducements, because what the market will need opposite participants. Like I said, if the market truly intends to reach this zone, what it's going to do is it's going to create a zone where people will have to put buy stops.
Yeah.
People are going to put buy stops, and people are going to be putting their stop losses for those those who actually think that, okay, the market is going up to this point and they're early. They're going to do what? They're going to buy and put their stop losses below. And I told you that when you buy the market here and you put your stop loss here, what you're putting down here is a sell order. You want to sell back what you bought at a lower price now, which is why you're making a loss. Now, this means that we have people that are placing sell stops and those who are placing sell orders in the form of stop losses. So the market needs those sellers to be activated so that buyers can have liquidity. Liquidity is simply money. So we will now look for a key level, which is our order block, below that zone of inducement or that zone of liquidity, where the market is going to do what? Tap in, activate all these people here. And now, if we are buying here, we know that we are buying from the people that were under this low, and the market can now move swiftly into our key level. All right?
Yes.
Now, it is very simple. I don't really want to complicate it, but you have to understand the logic behind the way the market moves. If you don't understand the logic, it will be difficult. You will always be trapped trying to buy here, and the market takes you out and goes your direction.
That's true.
Now, good. If we have this other block here, and you don't want to buy directly from here, what you're going to do now is you're going to now use the definition, or you're going to now use the model 1 entry that we talked about, which when price trades into this zone, filling this other block, now you are looking for price to close above the last bearish candle here, which is going to be our other block.
Yeah, that's true.
Talking about higher time frames. Higher time frames, we use other blocks on higher time frames as key levels, like I just mentioned. Okay.
Yes.
Also, one thing that you need to understand is that when the market is bullish on the higher time frame, every bearish candle is going to act like a support. Okay.
Yes.
When the market is bullish on the higher time frame, bearish candles will act like support.
Yes.
When the market is bullish. So you take note of bearish candles because there actually are other blocks. Every last bearish candle is likely going to act as a support, as you can see here.
So for the bearish candles, you are looking at the last candle.
Yes, because the
change of the last candle.
Good. Sometimes you can have series of them like this one. These are like more like model 1 because, for example, when this one was formed,
model 1. Yes,
this one was formed, right? So the moment price closes above it to this day, because this is the daily time frame. This day, the moment price retests, I'm going to be buying.
Yeah, that's true.
Now the same thing here. When price close above and then trying to retest, with the moment it retests, I'll be buying.
Yes.
Same thing here. The moment price closes above this one, I know that it's going to act now like a support. So as it retests, I'm buying. Same thing here. It close above, I know that it's now supposed to become a support. When it comes back, I am buying. It happens to the same way